Welcome to the Daily Consolidation, your essential daily briefing on Wall Street's most important moves. Bringing you the market insights that matter, delivered right after the closing bell. Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Well, today really was quite the ride in terms of central bank messaging.
It started off pretty calm, didn't it? The market seemed anchored by that expected rate cut.
Exactly. A 25 basis point cut, pretty much baked in. Stocks were ticking up. Everything felt orderly.
And then 2:03 p.m. Eastern hit, Fed Chair Powell starts talking, and boom.
Total reversal. The whole mood shifted. It was quite something to watch.
So what was it specifically? What did he say that just, flipped the switch like that?
It came down to his forward guidance, his language about what happens next. He essentially shattered the market's comfortable assumption about December.
The next meeting.
Right. He said, and this was the key line, a further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it.
Far from it. Oof. That's not subtle. That injects real doubt, doesn't it?
Completely.
Yeah.
You saw it immediately in the probabilities. Yesterday, the market was pricing in, almost a 90% chance of another cut in December?
Yeah, seemed like a sure thing.
Well, after that comment, it dropped like a stone, down to about 67%.
Wow. That's a massive repricing just based on a few words.
It tells you how much the market was leaning on this idea of a smooth, continuous easing cycle. Powell just poured cold water on that. He basically said, we're keeping our options open.
And the bond market certainly reacted as if its assumptions were just upended.
Oh, absolutely. Huge moves there. The 10-year Treasury yield jumped over 8 basis points, back above 4% to 4.072%.
Yeah, in the 2-year, even more sensitive to Fed expectations, right?
Even more. It climbed over 10 basis points, hitting 3.602%. It's a stark contrast to last week, when that soft CPI print had everyone feeling good about a soft landing and yields were falling.
So today wiped that out.
Pretty much. It signals a major reassessment of where the Fed might be headed.
Okay, but amidst all that drama about the next rate move, there was another significant Fed announcement that almost got buried, wasn't there? About quantitative tightening.
Yes, good point. And it's actually quite important. They announced their ending QT, stopping the balance sheet reduction effective December 1st.
Ending QT. So they'll stop shrinking the balance sheet. How should we interpret that, especially alongside the hawkish talk on rates?
Well, it's kind of the Fed giving with one hand and taking with the other, or at least sounding like they might take with the other. Ending QT means they stop actively pulling liquidity out of the system by letting bonds mature without reinvesting.
So it removes a headwind for the bond market.
Exactly. It doesn't add liquidity like QE does, but it stops the drain. It's a technically supportive move for bonds, a sort of underlying dovish tilt. Even while Powell is talking tough on the policy rate itself, it's strategic.
Interesting tension there. Okay, let's pivot to stocks, because we saw this real split personality today. The Nasdaq managed a gain, right? A new record high.
Yeah, Nasdaq Composite up 0.5%, closed at an all-time high. But the broader market didn't fare so well. S&P 500 finished slightly down. Dow slipped about 0.2%.
So strength concentrated at the very top. And speaking of the top, Nvidia, just wow.
Historic day for Nvidia. It officially became the first public company ever to reach and crucially hold a $5 trillion market cap.
$5 trillion. And it wasn't that long ago we were talking about $4 trillion, was it?
Just 3.5 months ago. The acceleration is staggering.
What's the immediate fuel for this latest surge? Still the AI story.
It's AI plus geopolitics and potential China sales. There's a lot of optimism building around President Trump's meeting tomorrow with Nvidia's CEO, Jensen Huang.
In South Korea, right?
Yes. And Trump specifically mentioned they discussed the Blackwell's chips that's Nvidia's latest, most powerful generation.
So the market's thinking maybe a path opens up for selling those high-end chips into China, despite current restrictions.
That seems to be the hope driving the valuation. Any perceived softening of export controls towards China for these cutting-edge AI components sends the stock flying.
Fascinating how sensitive it is to those specific trade whispers. And it wasn't just Nvidia feeling the AI demand pull, right? Caterpillar had a huge day.
Massive day for CAT, up over 10% on earnings. And that's not about digging holes for buildings.
Right. This is the AI infrastructure story playing out.
Exactly. It's about the booming demand for power generation. Those AI data centers are incredibly power hungry, and Caterpillar makes the generators needed to run them. It's tangible, industrial-level demand driven by AI.
So, big tech and AI infrastructure powering ahead, but elsewhere, Powell's comments cast a shadow.
Definitely. Rate-sensitive sectors felt that chill immediately. Real estate got hit hard.
REITs especially.
Yeah, residential REITs were down anywhere from 2 to 4%,
Yeah.
compounded by some negative earnings commentary, too. Financials also lagged.
Makes sense. If the market suddenly thinks rates might stay higher for longer, or at least not fall as quickly, sectors that rely heavily on financing feel the pinch first.
That's the textbook reaction.
Mm.
Higher expected borrowing costs hit their valuations immediately. We also saw staples lag, some commentary there about consumer softness, maybe?
But it's interesting, isn't it? We have this booming demand narrative driving Nvidia and Caterpillar, but then REITs are falling on rate fears. Is it just a mechanical repricing, or is there a disconnect?
It's largely that mechanical repricing of rate expectations, I think. Uncertainty hits, valuations adjust instantly in those rate-sensitive areas. But it highlights this really critical issue we need to talk about: market breadth.
Right, the idea of how many stocks are actually participating in the rally.
Precisely. Look at the week so far. The main S&P 500 index, the cap-weighted one, is up over 1.5%.
Wow.
Sounds good. But the equal weight S&P 500 index, it's actually down almost 1% this week.
Wow, that's a big divergence, over 2% difference.
It's huge. And it tells you this rally is incredibly narrow. It's being driven almost entirely by a handful of mega-cap tech stocks like Nvidia. The average stock is not doing well.
So, you could say the foundations look a bit shaky. If those few big pillars wobble, the whole thing could come down.
That's the concern, exactly. It makes the market very vulnerable if something spooks those leaders.
Okay, let's look beyond equities. Commodities had some wild moves too, copper especially.
Jaw-dropping day for copper. It hit $11,146 per metric ton. That's its best performance since, 2017. Just an incredible surge.
What's behind that? Is it just demand or something else?
It's a perfect storm, really. Strong demand from electrification, EVs, data centers, meeting severe supply problems.
Supply problem.
Yes, the big news today was Freeport-McMoRan declaring force majeure at their huge Grasberg mine in Indonesia.
Force majeure meaning they can't meet their delivery contracts due to unforeseen issues.
Correct. Operational problems hitting a major supplier. And this comes on top of broader concerns. Analysts are forecasting a pretty significant copper deficit next year, maybe around 400,000 tons, because of expected supply disruptions lasting into 2026.
So, constrained supply plus high demand equals record prices.
That's the equation. Meanwhile, gold sort of found its footing, didn't it?
Yeah, up about 1.5%, back over $4,000 an ounce, stabilizing a bit after that massive plunge last week.
It seems to be digesting those mixed signals, a rate cut today, but maybe fewer cuts down the road. But you know what didn't seem bothered by the rate volatility today?
What's that?
Credit markets. Corporate bond spreads barely budged.
Really? Despite the treasury yields jumping, why so resilient?
It suggests the market still feels pretty confident about corporate health. Investment-grade spreads stayed really tight, near 78 basis points. That's like the bottom 5th percentile historically.
And high yield.
Same story. Held around 281 basis points, which is near multi-decade lows. The message from credit seems to be, companies are doing fine, recession risk is low, we're not worried about the Fed's day-to-day chatter.
But when spreads are that tight, does it leave much room if things do sour?
That's the risk. There's basically zero room for error priced in. Any whiff of trouble, weaker earnings, rising defaults could cause spreads to widen out very quickly because there's no cushion. Perfection is priced in.
Got it. And the dollar. A rate cut usually weakens a currency, but the dollar index actually firmed up a bit.
Counterintuitive, right? But it goes back to Powell's comments. By pushing back against the expectation of more cuts soon, he effectively made holding dollars slightly more attractive relative to other currencies where easing might still be expected. So the dollar stabilized, even rose slightly.
Okay, so looking ahead, a lot of uncertainty seems to be the main theme now. Powell himself admitted the Fed committee is divided.
He was unusually candid about that, wasn't he? Saying there were strongly differing views on the December move. That lack of consensus within the Fed itself adds another layer of unpredictability.
And then there's the government shutdown dragging on, creating a data blackout.
Right, 4th week now. Powell mentioned that too. He suggested that if the lack of reliable economic data continues, it might argue for being cautious, for not moving in December. So the shutdown itself is now a factor in policy.
So Fed divided, data missing. And then we have this huge external event tomorrow.
The Trump-Xi meeting in South Korea. Absolutely critical. It's happening just before that November 1st deadline for potential huge tariffs on Chinese goods.
What are market participants hoping for or expecting there?
The base expectation, I think, is some kind of truce or extension, delaying those tariffs. If that doesn't happen, if the rhetoric is harsh or suggests tariffs are imminent, that could really rattle markets, especially combined with the Fed uncertainty.
So how does this all shape up for the rest of the week? What are the potential paths folks are watching?
Well, the sort of middle ground scenario, maybe 50% odds, is that we get a tariff truce. Markets probably chop around, consolidate maybe between 6,850 and 6,920 on the S&P. Tech earnings might offer some support, but that breadth issue, the narrowness, likely persists.
And the downside risk.
That's if the Trump-Xi meeting is a disappointment. No truce, maybe even tougher talk. That, plus Powell's caution lingering, could see a correction towards, say, 6,750 or 6,800 on the S&P. It feels quite binary based on that meeting outcome.
And for education, key levels people might be watching.
On the S&P, maybe support around 6,890, resistance near 6,920. For the 10-year yield, that 4.10% level is key resistance now. And for copper, holding these highs, maybe watch $11,200 as the next resistance point.
Okay, so wrapping it up, Nvidia hits an incredible $5 trillion milestone fueled by AI and trade hopes. But the bigger story today feels like the Fed throwing a wrench into the market's rate cut assumptions.
Absolutely. And the core vulnerability remains that extreme concentration in just a few mega-cap stocks, shown by that big lag in the equal weight index.
Meaning the rally's foundation looks narrow and very exposed to any negative surprises from the Fed's uncertain path or, crucially, tomorrow's Trump-Xi meeting.
Yeah, the big question now is whether that tech momentum, driven by AI and maybe some geopolitical optimism, can keep defying gravity when faced with real policy uncertainty and the risk that those few supporting pillars could start to wobble.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe and we'll see you at the next close.